Chapter 4, Completing the Accounting Cycle. The worksheet is an optional tool that can be helpful in the compilation of accounting data as well as the preparation of financial statements. The column headings are Account Titles, Trial Balance, Adjustments, Adjusted Trial Balance, Income Statement, and Balance Sheet. The first column reflects the account titles. Account balances from the general ledger are entered into the corresponding debit-credit columns to prepare the trial balance. Adjusting journal entries are entered into the next columns. The adjusted balances are entered and comprise the adjusted trial balance. The revenue and expense account balances are extended into the income statement columns, and the asset, liabilities, and owner's equity balances are extended into the balance sheet columns. The net income is reflected at the bottom of the worksheet. Here is an example of a complete worksheet. The first section reflects the unadjusted trial balance and, as is true with trial balances, the debit total of $28,700 equals the credit total of $28,700. Next, the adjusting journal entries are recorded. Adjusting entry A reflects the adjustment for supplies and includes a debit to advertising supplies expense and a credit to advertising supplies. The total debits and credits are $3,440. Next, the adjusted trial balance is presented. Note how the unadjusted balance of advertising supplies is $2,500, and after the adjustment of $1,500, the adjusted amount is $1,000. The adjusted trial balance contains equal debits and credits of $30,190. The income statement column reflects the revenue and expense accounts. Total debits, expenses are $7,740 and credits, revenues are $10,600, resulting in net income of $2,860. After the net income is included, total debits of $10,600 equals total credits of $10,600. The last columns reflect the balance sheet data. Debits and credits are totaled, and after net income is included, in the credit column, total debits and credits equal $22,450. At the end of the accounting period, the company will need to get the accounts ready for the next accounting period. The temporary accounts are closed or zeroed out. The temporary accounts include revenue, expense, and the owner's drawings accounts. The permanent accounts are not closed. The permanent accounts are asset, liability, and owner's capital accounts. Closing entries result in the transfer of net income or net loss and the owner's drawings to the owner's capital account. The closing journal entries are prepared only at the end of the annual accounting period. Usually there are 4 closing entries. The first closing journal entry involves closing the revenue accounts to the account titled Income Summary. The Income Summary account is a temporary account that is only used during the closing process. The next closing entry involves closing the expense accounts to the Income Summary account. After the first 2 closing entries, there will be a balance in the Income Summary account. The third closing entry closes this balance in the Income Summary account which is the net income or net loss, to the owner's capital account. Finally, if there are any owner's drawings, they are closed to the owner's capital account. Here is an illustration of the closing process. The first closing entry closes the revenue accounts. Because revenues have a normal credit balance, in order to zero them out, it is necessary to debit these revenue accounts and then credit the income summary account. The result will be an ending zero balance in the revenue accounts. The second closing entry closes out the expense accounts. Because expenses have debit balances, to zero them out, it is necessary to credit each individual expense account. The income summary account is debited for the amount of total expenses, in this case $7,740. The third closing entry closes the balance in the income summary account. This balance is the net income or net loss. In our example, the balance in the income summary account after the first two closing entries is a credit balance of $2,860. In order to close the income summary account, it is necessary to debit the income summary account and credit the owner's capital account. Ask yourself if the $2,860 is net income or net loss. It is net income because total revenues of $10,600 minus total expenses of $7,740 equals net income of $2,860. Net income increases owner's capital. How was owner's capital increased? Remembering back to our debit-credit chart, owner's equity increases with a credit. Therefore, this third closing entry includes a credit to C.R. Bird Capital for $2,860. The final closing entry involves closing the owner's drawing account. Because owner's drawing is a debit balance before closing, it is necessary to credit the account to zero it out. How do drawings affect owner's capital? Drawings reduces owner's capital. Therefore, the owner's capital account is debited in this closing entry. These four closing entries need to be posted to the accounts in the general ledger. The post-closing trial balance is prepared after the closing entries have been posted to the general ledger. The total debits and credits equal $21,950. Only accounts with a balance are included in the trial balance. Which accounts are not included on this post-closing trial balance? There are no revenue, expense, or drawings accounts on the post-closing trial balance because they have been closed. These temporary accounts have zero balances. The accounts included on the post-closing trial balance are the permanent accounts. The accounting cycle is summarized here. Business transactions are analyzed and journalized. Chapter 2 illustrated the journal entry process. The journal entries are posted to the general ledger accounts, and the ending account balances are used to prepare the unadjusted trial balance. This was also illustrated in Chapter 2. Chapter 3 illustrated the adjusting entries necessary to ensure the revenue recognition and matching principles are followed. After the adjusting entries are posted to the general ledger, an adjusted trial balance is prepared. From these adjusted balances, financial statements are prepared. In Chapter 4, the closing journal entries and post-closing trial balance were illustrated. The appendix illustrates reversing entries. Reversing entries relate to adjusting entries. Companies make reversing entries at the beginning of the next accounting period. Reversing entries are the exact opposite of the adjusting entry from the previous period. The following is an example. On December 31, 2010, an adjusting entry for the accrual of salaries involved debiting salary expense for $1,000 and crediting salary payable for $1,000. The reversing entry on January 1, 2011 would be the opposite. Debit salary payable for $1,000 and credit salary expense for $1,000.